Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, over the past 3-4 years, most of us had started believing that markets only do well. They are unidirectional. But then September 2024 happened, and since then the markets have been, they've been volatile, and it has unnerved many investors. So, what should you do in such circumstances? How can you prepare yourself? So, in today's session, let's discuss the 5 essential questions that every investor must ask before beginning to invest or reviewing your investments. To discuss that, we have with us Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Now, let's dive right in. So, what is the first question that investors must ask themselves before making any investment?
First is that they have to decide deliberately to ask questions, because most people, they just invest. I think it must start with the first question which he should answer himself. What is the goal? And the goal could well be that, market is going up, I have to invest. That can also be a goal. But, that then he should not complain. He's basically taking a bet on riding the market. But asking question will save you from disappointment, because most of the time what happens is when you do those things, you think that the recent past or whatever you are seeing and getting impressed with will repeat itself. And that will not be true. If you do not start with this question, that why are you doing something, then the fact that you came to the market just because it was going up, you will abandon it the moment it starts going down. And that will be depriving yourself of this great opportunity.
All right. So once the investor has established the purpose of investment, what should be the next critical question?
Next critical question is that, by now most people would have got the feel of it. When you start investing, and if you're seeking the help of an advisor, he will do your risk tolerance and all that. That is a stated risk tolerance. You will give some answer to some question, and you will get a sense of that, okay, I can absorb this risk, and I have a high risk tolerance and all that. That is a stated one. Only when the market falls that you realize that what is your real risk tolerance.
Yeah.
How much sleep are you losing is a critical question. And then that is the time when you actually discover that what is your comfort zone. If market fell and you did not lose your sleep, you really figure out, okay, what is the risk tolerance. Also, this risk tolerance varies. It is all a function of your context, your situation, and nobody knows it better than that. Nobody can really figure out better than you yourself. And based on that, you have to really act. Use this opportunity. What has happened in the last 6 months should be used by every investor to figure out their real risk tolerance. And in fact, there will be few investors, not too many. And that is actually the Indian context. A lot of Indians are very young and they have started doing their SIP. They have invested in an NFO or any such thing, and they may not have run for cover by now. But they would have definitely be shaken by what has happened in the market in recent times. More so, not because market is doing anything unusual, just because they haven't experienced it in the past. So use this opportunity to figure out what you can really take and what you can't.
Okay. So once you've figured out what's your purpose of investment and what is your risk appetite.
Yeah, how much beating can you take?
Yeah. So what should be the next step?
Next step is that, try and understand a little bit about where are you invested? How does it work? It's like a black box. They just think of it that, okay, this is XYZ fund. And something is happening. I don't know, what is their understanding. But trying to figure out that, if you have invested in an equity fund, say an index fund, what exactly has happened? You invested 50,000 rupees. What happened to that money? Where did it go? And why are you getting return? Why it is going down in value? Because unless you understand what is going on. So when you invest in a fund, the money goes to the fund manager. And the money gets invested in, you become the proportionate owner worth your money based on that NAV of that underlying investment. Those underlying investments are trading every day. That is why NAV gets calculated every day. But behind that, all those companies, millions of people get up every morning to do that business, to do that activity, to produce something, to provide a service, to do some trading, whatever, product or services. So if you don't have this understanding, all you know is price goes up and price goes down, then you will panic. If you don't understand how things work, then the complexity of investment will drive you out of the market in the downturns. Understanding how things work a little bit, and by little bit, I mean listen to Investor Hangout. Come to us more often. Because this is also the purpose of Investor Hangout. We help you understand, or we are most people think that we are doing some groundbreaking research. With Investor Hangout, our objective is to do some explainer of some basic stuff which helps you understand and appreciate what is going on with your money.
Right.
And that helps you stick around.
So once you've understood the purpose of investment, done your gauged your risk appetite, and understood the instrument that you're investing in, what should be the next question?
After you have done this, you have to really figure out that how does it affect you? Assuming that you invested in some good fund when you started investing because you saw the past performance, but you didn't, and you also tried to figure out. But then it turned out to be outstanding investment. But it turned out to be one concentrated investment. Because of this concentration, it did exceptionally well. And because of this concentration, it is falling the fastest. It has translated into the biggest loss. Or it has, the steepest decline for fall. So figure it out and figure out, what is the concentration, whether it is intentional. I think applying this much of thought, that where you are, how much you are diversified, how much are you concentrated, and why, as a result of everything that you own, by virtue of all the first three questions, I think that will come in very handy, and then, you will not lose your sleep.
So now, one last question that would help us stay the course in difficult times like these.
Once you have done these 3-4 things, then I think, the market goes down by 20%, 30%, 40%. Because you have planned all this, you'll not lose your sleep. The result of all this will be that you will end up having a plan. The question to ask that is that, the money which you might need in emergency will not be in a sector fund, or will not be in a couple of stocks which you actually took a chance with. The long-term money should be invested in equity. The short-term money should not be invested in equity. And this can happen only as a result of asking these questions, the first 4 questions. And then the result of that will be that, you will not exit in a panic. Exiting in a panic is the worst thing that happens to an investor. Not only do you lose money, you came with great expectation, you lost money, and by selling it, you make your losses permanent. But even worse than that is that here is this great opportunity, here is this great vehicle, here is this great mechanism whereby, the worst that can happen to you is that you will lose your capital. But the best that can happen to you is that it will go up by 10 times, 20 times, 40 times, 100 times, 1,000 times in your lifetime. And you will be deprived of that. Configure yourself in a manner that, you don't panic and you don't get out of it at the worst of times.
Now that we've covered these 5 essential questions, moving on to a question sent by one of our viewers who is an ardent fan of yours, Mihir Patel. He says that he's investing with a long-term horizon of 10 to 15 years and is wondering about the need for rebalancing during periods of market corrections. He's specifically asking if in a market downturn there's any need to sell or rebalance when his investment horizon is too long. Also, he's come across some mutual funds which have had periods of underperformance but have delivered strong long-term returns over the past 30 years. So now he wants to know if a fund is not performing well for, say, 5 years, should he continue holding it for his long-term goal, or is it wise to make changes to his portfolio?
Thank you, Meher, for just reinforcing the belief that we have been talking about, reinforcing over all these years, last 10, 20, 15, 20 years. If I have to summarize that, I greatly appreciate you believing or buying into the whole concept that less is more. You have to do very few things. You need to rebalance, but rebalance is not replacing a fund, is not selling a fund. Rebalance is always a result of having an asset allocation. That is something which you have to decide yourself, that you want to be substantially into equity, nominally into fixed income. You need to be substantially into fixed income, nominally into equity, or you want to be equally into equity and equally into fixed income. So these are, and there is no fixed formula. I don't think there is any scientific basis for me to say that 2/3 equity or 3/4 equity is a good thing. 2/3 equity might be a more aggressive stance, and it also presents a greater opportunity, or 3/4 equity will present you a greater opportunity to rebalance. And once you do this, assuming that you decide that 75% will be in equity, 25% will be into fixed income, and this 75% as a result of market steadily going up becomes 85%, then you will be able to sell. Now when the market has gone down by 20%, this 75% which you rebalanced has become 70%. Then you will be able to move money from fixed income to equity to make it sell. So restoring the allocation, and restoring the allocation not very often, either annually or when it goes out of whack. If the 75 becomes 78, don't fiddle with it, because try and avoid, less is more even now, and in fact it has become even more important, because earlier there used to be no capital gains tax. Now there is. So 12.5% of your gains or 20% of your short-term gains will actually disappear. You will have to pay by way of taxes.
Yeah.
So I believe that you should stick to this principle of less is more and not acting in a half. Second is that, when you should sell a fund, should you stick around? One is that, when we make you see all these ratings, 5-star, 4-star, 3-star, and sometimes it's a relative ranking. It's a relative within its own category. When you look at a 5-star fund in a flexi-cap universe, then the 5 stars are basically top 12.5% of the flexi-cap funds. And slipping from 5-star to 4-star, I will just notice it. It'll be on my radar, but I won't really worry about it. Slipping to 3-star, I won't even bother, because they remain investment-worthy investments. And just that on a relative basis, something else is doing little better or little worse on a risk-adjusted basis, which is shifting these funds. So it is a relative thing. And if you choose an inappropriate fund, and you buy a 5-star one, it will still disappoint you. For example, if you buy a 5-star conservative hybrid fund, and it might be an excellent fund of that kind, but if you're investing for many, many years, if you're investing for 10 years, you will not get anything meaningful. You have to choose the appropriate category for the appropriate, expectation and time frame. So if you are in a reasonable category, something which and this is something which I have grappled with. There's a good fund and is doing not so well, and is not doing so well and crosses 5 years. Should I still stick around? I would say that if there is a good fund, which is relatively new, 5-year-old fund, as compared to a good fund, which has a 20-year history, I will give this fund with a 20-year history 5-7 years time. If it is not becoming too disappointing, if it is actually becoming worst fund at the bottom of the category for a long time, but I will still give it 5-7 years. So I would say that unless there is something very alarming, if there's a corporate governance issue, if you come across a news item which scares you, that here's a fund in which you invested and the fund manager is being, has done something messy and the regulators are after him, and there have been such instances once in a while. That is something where I would like to keep away from any such thing. But on a performance count, unless something very dramatic happens, if the fund has actually lost demonstrate that it is not doing the essential which I expect from a fund, I would still hang around with the fund for a longer period, even with underperformance, if it has a long history. Thank you, Meir, for asking that very relevant, timely, and something which is causing anxiety to many investors, all in a single question. And I find this very basic, essential questions of relevance to everyone. So I'm writing the next first page column answering your questions.
Right. Well, thank you, Dhirendra, for these valuable insights. Hope, Meher, you've got your answer there. That's all we have for you in this episode. Keep watching this space for more information. Thanks for watching. Bye for now.